Hey citizens, Anthony the Internet Politician here. Have you ever wondered about that IRS Form W-4 that you fill out whenever you start a new job? What about when you are filing your taxes and your federal return seems low or you owe money? IRS Form W-4 could both be your problem and solution. The 2024 IRS Form W-4, which I will now simply call the W-4, is a 3-page document used to calculate how much a business should take from your earnings. Known as the Employee's Withholding Certificate, employees answer a few questions and perform a little math to determine how much tax an employer should withhold each pay period. For the purposes of this video, we will only be focusing on the first page of the W-4 since the second page is the instructions and the third page is about multiple jobs and itemized deductions. However, some people may never actually see a paper W-4. Businesses with online hiring processes have boiled down the W-4 to a few simple questions. Funnily enough, back in the old days, you really only had to worry about marking in box 5 how many people you were claiming. On that front, if you are completing an employer's digital W-4, it may simply ask you 2 questions. The first question is, how many people are you claiming? This would be yourself and any dependents. The second question is, how much extra withholding would you like to have? I will get into both of these as we go through the W-4. Step 1 asks you for some personal information, such as name, address, social security number, and marital status. The information in this step needs to match what you intend to apply towards your next tax filing. You can always update any part of the W-4 with your employer as needed. Step 2 pertains to those with multiple incomes, including couples who file their taxes as married filed jointly. Line A generally applies to self-employment income. Line B is for those with multiple jobs. Line C continues the multiple job angle, but if the lower paying job still earns more than half of the income of the higher paying job. Step 3 is about family. More accurately, who is going to be claimed. This used to be a single number definition of dependents, but now breaks it down into potential tax credits. There are a lot of rules about who qualifies for which tax credit, and we are not going to cover that here. That takes us to a simplified version of the difference between claiming dependents or not. If you define 0 on line 3, the most possible taxes will be taken from your pay. If you decide to claim any dependents, you will be taxed less under the assumption that you will make up for it in tax credits when you file your taxes. It is a risky roulette if you define dependents and actually find out that you cannot claim some or any of them. Step 4 brings everything together from steps 2, 3, and page 3. Line A allows you to pre-tax anticipated non-job income during the year, such as interest, deductions, and retirement income. Line B is where page 3 comes in, but we are not covering that here. Line C is about additional withholdings taken out of each pay. It can be nothing or something. If it is something and you do not anticipate owing the IRS, you will get a larger tax refund. We will go into how to reduce a future federal tax debt momentarily. Step 5 is where you sign and date the form. If you are filling it out on your own via paper, do not forget this step. Once you are done, turn it into your employer or whatever human resources specialist they have available. So now we get to the part about what to do if you owe taxes to the IRS when you file. This is where the extra withholding field on line 4C comes in. The math is fairly simple, assuming that your pay is regular. For example, let us say that you owe the IRS $1,000 after filing your taxes in 2024. While we can do nothing to assist with that amount for that year, we can prevent it from happening again in 2025. We are also going to assume that you earn $1,000 every 2 weeks. A nice round number makes it easier to calculate. That means that in a 52-week year, you get paid 26 times for a total of $26,000 per year. We then need to calculate how much to withhold from each pay to reach $1,000 after to whatever amount of pay periods remain in the year after you file your taxes. Assuming that we have a full year of pay periods left, that would be $38.46. Now, these numbers assume that nothing about your income will change much year over year. If you earn more or less money, the degree of how much you will owe may change. Either way, you are asking your employer to take an additional $38.46 out of each of your pays in taxes. The goal is to end up with enough overpaid taxes to cover the potential future tax debt. Obviously, you can increase that number if you want to gain a more substantial tax return. Before we wrap this up, the most common reasons why someone may owe the IRS is because an employer is not taking out enough federal income taxes. It could also more specifically be because the percentages for Medicare and Social Security are too low. The correct percentages in 2024 are 1.45% for Medicare and 6.2% for Social Security if an individual makes less than $200,000 a year. This also assumes that there is no employer-sponsored health care. Another reason is if someone bought subsidized healthcare through the healthcare.gov marketplace, received an IRS Form 1095-A, and failed to report income changes during the year. The debt is both a penalty and an offset to make up for changes in taxable income. Boy, that is a lot of information. Simply put, for the most taxes to be taken out of your pay, define zero on step 3, line 3. You can download the forms that I have mentioned here via the official IRS website in this video's description. Tell me in the comments your thoughts on this video. Did you like what you saw, and how was your experience with it? Thanks for watching, and please remember to like and subscribe.